USB Talks. Today is Wednesday, October 25th, and I'm joined once again by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Good morning, Vinny.
Now, Nick, there's only one place to start. I think a lot of the headlines have been grabbed in recent weeks about the US 10-year Treasury Note has jumped through the 5% barrier for the first time in 16 years, so back to before the GFC. And that's certainly having a knock-on effect on markets.
Yeah, it's come as a bit of a surprise. I think we've spoken a little bit about it before, the bear steepening. And there's been a lot of different reasons put forward as to why yields, particularly long-end yields, have risen so much. It's come down to the less fears around a recession, better economic data, ongoing resilience, the higher for longer narrative from central bankers. As well as what they call a rebuild of the term premium, and that's the premium that investors demand for holding longer dated bonds, where the inflation and economic outlook is maybe a bit more uncertain over a 10 to 20 year horizon.
Yeah, so I guess one of the key questions is, given the rapid run-up we've seen in yields over the last couple of years now, or 18 months in particular, how much further do you think it has to go? And maybe we have to unpack that as you talk about some of the other indicators that are out there in the world at present.
Yeah, I think it's, it's very difficult to put a number on it near term. Bond yields could potentially rise higher, but I think they still have to come back to the path of short-term interest rates. And, we have the cash rate in the US at 5.4%. The Fed officials are expecting to cut that over the next couple of years. Their estimate of the neutral rate is 2.5%. So I think it seems, in my mind, unreasonable to expect the average interest rate over the next 10 years to be about 5% when they've told us that 2.5% is what they think is the neutral rate.
So there are probably a couple of questions there. One, is 2.5% really the right number? Possibly too low. 5% probably seems too high, perhaps somewhere in the middle.
That's right. But whatever it is, 5% seems like pretty good premium over what the path of the short-term rates will be over the next 10 years, particularly if you have any kind of growth shock or inflation comes down as is forecast.
For so long, we had next to no premium in the system and next to nowhere for central banks to move, and suddenly now bonds have a role to play as a buffer, as an insurance policy, potentially again.
Well, that's right. Absolutely. I mean, as I've spoken about, bonds do play a role, particularly if we get a growth slowdown. And, as I've mentioned, higher rates can in turn create their own, they can create their own problems. They can bring on a recession. So they sort of sow the seeds of their own destruction, if you like. And if we do get a slowdown, which some people still think is possible next year, you could see bond yields go from 5 back to 3 and get a pretty good capital gain from bonds in that scenario. I
was going to say this rise in the 10-year Treasury Note is possibly helping do part of the Fed's work for them as well.
Well, that's right. Actually, last week we had Fed Chair Powell speak at the Economic Club of New York, and he did say at the margin the rise in longer-term bond yields may reduce the need for further short-term interest rate hikes. But he was cautious to say at the margin and to do the usual central banker
caveat
everything.
Yeah.
Yes.
Let's come a little bit closer to home. I just want to be conscious that we are recording here at approximately 9 a.m. this morning. Later today, we're going to see those September quarter CPI data released. Let's talk about what we might see and what that could mean for the RBA in terms of their next move on interest rates, conscious that we're not far off from Melbourne Cup Day and not far off from that very important Melbourne Cup rate decision. What are you expecting, and what do you think that may lead to in terms of Michelle Bullock's next move?
Yeah, so the key measure that everyone looks at is the trimmed mean measure of inflation, which I've spoken about before, which chops off the top and bottom movers. And that's expected to rise 1.1% in the September quarter, up from 0.9% the prior quarter. Now, that increase is obviously due to things like the softer Australian dollar, which increases imported prices, the rise in fuel prices, and various other things. And if it comes in at that, which would be 5% year on year, down from 5.9%, that would probably be a bit higher than what the RBA had penciled in August in their own forecasts. So it will really depend kind of where it lands and whether the RBA, which will publish a new set of forecasts ahead of the November board meeting, if they revise up their path of inflation, then it could prompt the RBA to put in another rate rise. So last night we had Michelle Bullock delivering her first formal speech as RBA governor at the CBA forum, and she did highlight that if their forecasts were for inflation to be higher or take longer to get back to their target, they wouldn't hesitate to raise rates further. So I think, depending on where we get the inflation number today, we could see another rate rise in early November.
And where are the markets pricing on that? The last time we spoke, it was borderline 50-50 whether we see that November move. Has it changed much? And I guess all eyes will probably be on today's number.
It's currently a 1 in 4 chance of a rate rise, and about 50% priced by probably about March next year. So they're still saying it's a 50-50, but not necessarily at the November meeting. Right. We are going to get another wages number in early November or mid-November, I believe. So that also could be another live data print that does push the RBA a little bit higher. Interestingly, we also did get some commentary from Michelle Bullock last night about this dual mandate. So she did indicate that she's in discussions with the Treasurer on, what full employment looks like and how that potential trade-off between inflation and full employment might work. Although she did push back on the idea that there would be a specific number that was full employment, and that there would be some sort of rules around how inflation and full employment may be traded off in this scenario where they needed to be traded off.
We think monetary policy is a pretty blunt instrument. It's hard enough to manage inflation. Using it, trying to theoretically manage a dual mandate of inflation and full employment seems almost impossible. But
well, they also have financial stability as one of their objectives as well. And she did say that where full employment and inflation traded off financial stability, they would favour financial stability.
Yeah, above all else.
Mm.
All right, well, let's see where that number takes us today. And I guess essentially we're where we were before. We're at the 4.1% mark with a bias to probably one more rise and data dependent from here.
Yeah, I mean, she did speak about progress of, slowing demand and moderating inflation, so that was on the plus side. But then she also pointed out to still elevated savings within households and rising house prices. So it was very much a two-handed sort of economist view of the world. Yeah,
very diplomatically handled. We had some data out of China as well. Just again, all eyes there in terms of they're trying to manage sort of a re-spark of their economy.
Yeah, it was actually pretty good data for the GDP for the third quarter, which, I'm always amazed they can publish their third quarter GDP data within 2 weeks of the end of the quarter.
Incredibly efficient system.
Incredibly efficient. But that came in stronger than expected. So their growth number year on year was 4.9, and that was above the expectations of 4.5. And it did seem like the economy there may have troughed. We've spoken about the problems that they have with the manufacturing sector, the property sector, and that there's still problems. But the consumer has certainly lifted, and services side of the economy has picked up. So it does look like the economy might have found a floor in terms of growth, not that it was declining, but a growth floor supported by very targeted stimulus packages and policies from the central government to try and put a floor under particularly the property sector.
Which has been a significant cause of concern for some time now. So I think we watched that one with significant interest for Australia exports in particular.
Yeah. Other data we got last night was preliminary purchasing manager indices. They're the business surveys, and interestingly, they continue to point to that US exceptionalism. The US data was still very resilient, whereas in Germany in particular it was very weak. So the European economy, possibly risks falling into recession in the second half of the year. Their credit numbers are also very weak. So we have the ECB meeting tomorrow night, they're expected to remain on hold. But yeah, certainly the European economy still looks pretty sluggish relative to the US.
They roll towards another winter, and unfortunately another winter where the Ukrainian conflict persists and the challenges that puts on their energy market, which we know comes under increasing strain in winter with the heating bills that they have there. Very, very early stages of the earnings season. Anything catch your attention there? Anything that you're particularly looking out for?
Yeah, it's still early days. From what I've seen, the number of companies beating estimates is roughly in line with average. We've had some good results from companies like Verizon, General Electric, Coca-Cola, 3M. Last night we got Microsoft that had a particularly good result, particularly within that sort of what they call the intelligent cloud division, which is tied to the AI theme.
Copilot.
And Azure, their data centers. So that was quite strong. Their revenue came in $2 billion higher than expected, and the shares were up in after-hours trading. On the flip side, Google also delivered pretty good results, but people were also interested in how its cloud business was performing, and that was actually relatively weak compared with estimates. So their shares were down. But overall, I'd say it's been a reasonably good earnings season.
A lot of eyes on the Magnificent Seven, no doubt, through this one as well.
Yeah, absolutely. And so far, from what we've seen in Microsoft and Google, at a kind of earnings level and a revenue level, they've certainly been delivering strong results.
Terrific. Well, thank you very much, as always, Nick. We look forward to that data coming out today, and we'll see what Michelle Bullock has for store for us in 10 days' time. Thank you to all our listeners. Take care.
Take care.